Okay, welcome back. We're made it. We're halfway through the course. Last week you all took your midterm exam. We are jumping into chapter 9, which is halfway through our textbook and halfway through our course. At least this part of the textbook, anyway. As you know, this book covers both financial and managerial accounting. The managerial part you will use for Accounting 202. This particular course, I believe, if I'm not mistaken, goes through chapter 16. So where are we now? So we're in week 5 out of week 8, and this course is 8 weeks in length. We cover 2 chapters per week, as you know. Under course content, we are in module 3, at the beginning of module 3 in week 5. We're covering chapters 9 and 10. Both are which kind of boring. The first one is on fixed assets. The second one is on liabilities. But I promise I'll try to make it a little bit entertaining. When we get to the end of week 6, which is, as you know, next week, when we get to the end of next week, you would have been 75% complete with the course, which is a wonderful milestone to be at. So, what do I want to talk about real quick? Housekeeping items. If you have any remaining quizzes, please make sure that you get those in as soon as humanly possible. Why? Because eventually you're going to get past the point where I will no longer accept late work. So please, if you have anything remaining outstanding, it must be submitted as soon as possible. I'm no longer asking. Okay.
I have a question.
Yes, please.
So I messed up and I started the process. Well, it's finished now. It's done. But are you going to take points off that the midterm wasn't done in the respond?
No, I won't do that.
Okay.
I don't want to penalize you for that, especially since I know that we got off to a rough start with this semester, so that's why I'm not going to do any late type of penalties. But yeah, good point.
I'm talking about the midterm.
Talking about the midterm, yeah.
Okay.
Yep. Okay. Good question. Yep. So please, again, if you have anything that's outstanding, get it in as soon as possible. Yeah. So, but the vast majority of you are on top of your work, which is fantastic. I know there are a few of you that still are having issues with our famous textbook store. So, and I'm working with you individually on that. All right, amigo, I got you muted. Okay, so let's go ahead and get rolling. Chapter 9. Long-term fixed assets. I want you to, when we talk about long-term fixed assets, the first thing I want you to remember when you hear long-term fixed assets or long-term assets, long-term, as you know, is greater than 1 year. Okay, long-term is greater than 1 year. Short-term is less than 1 year. Long-term assets, and just remember, just like this, long-term assets are property, plant, and equipment. Property, plant, and equipment. Those are long-term assets. Those are fixed assets. Fixed assets. Property, plant, and equipment. Then we have intangible assets. The word tangible means I can physically touch it. Tangible means I can physically touch it. Intangible means I cannot. I cannot physically touch a copyright. I cannot physically touch a patent. I cannot physically touch an idea. But it's still an asset. And we'll talk about that throughout the chapter. So fixed assets. These are long-term, relatively permanent assets like property, plant, and equipment. Equipment, machinery, buildings, and land. These are things that I can touch and they last a long time. Fixed assets. Fixed assets are also known as plant assets, property, plant, and equipment. Fixed assets have the following characteristics. They are physical. I can physically touch them. Therefore, they are tangible. They are owned and used by the company in its normal day-to-day operations of the business. They are used to generate revenue for the company. And they're not offered for sale during a part of normal operations. If the business is not in business to continually selling its property, plant, and equipment, that's not the concept of operating a business. That's not the normal day-to-day operations of a business. It's not to buy and sell property, plant, and equipment. Some businesses are, but for most businesses, that's not the case. So when you think of fixed assets, think that it's property, plant, and equipment. I can physically touch it. It's owned and operated by the company, and it's used to generate revenue for the company. As you know, with property, plant, and equipment or other fixed assets, there are costs that are associated with having those assets. So therefore, we classify our costs as being a fixed asset, an investment, or an expense. And we'll talk about each one. So when it's classified as a fixed asset, it's used as a part of normal operations. Let's talk about normal operations. First, let's go through the steps of how do we classify these. The first question you need to ask yourself is, was the property, plant, or equipment purchased, is it what we call long-lived? Long-lived means it has a long, useful life. A while back, I gave an example of a dump truck. Do you remember this example? The example was, I have a construction business, and in my construction business, I purchased a dump truck. The dump truck is said to have a useful life of 5 years, meaning I can get 5 years of use out of that dump truck before it starts to break down and is no longer useful, right? So is my dump truck a long-lived asset? That answer is yes. I can use that dump truck for 5 years to get its useful life for 5 years. So if the answer is yes, we record that item as an asset on the balance sheet as either a fixed asset or an investment. I would record my dump truck as a fixed asset on my balance sheet because I'm using that dump truck to generate revenue for my business. Therefore, it is a fixed asset. It would be an investment if I purchased the dump truck and it appreciated in value and then I sold it. That would be an investment. Or another example would be, I purchased this piece of land over here with the intention that the value of the land will increase and I will sell it at a later date. That's an investment. An investment is any time that you purchase something with the expectation that the value of whatever that was increases and then you will again sell it later. That is called an investment. So if it's a fixed asset or investment, we proceed to step 2. If not, then we classify it as an expense. So step 2 says, is the asset used in normal operations? My dump truck, yes, I use it every day to help me generate revenue. So therefore, it is classified as a fixed asset. If I do not use it every day or at all to help me generate revenue, then it's not an asset, it's an investment. Items that are classified as and recorded as fixed assets include things like property, plant, and equipment, also known as land, buildings, or equipment. These assets typically last for more than 1 year and are used in day-to-day operations. I use my equipment to produce my inventory to then sell. I use my building as an area to manufacture my inventory to get ready for sale. I use the land that the building is on to help me generate revenue. So the short term is that any time that your uh, property, plant, and equipment is used in day-to-day operations of the business, then we classify that as being a fixed asset, and it should be useful more than 1 year.
Yeah, Professor.
Keisha,
This is
yes,
Lakeisha. Yes,
yep,
hi.
hi,
I was getting ahead because I was started on this chapter as we speak,
great.
and I had noticed. We'll talk later. I'm gonna do a little meeting with you, but I had noticed as I was doing this chapter, like I didn't know that the cars on the lot is not the cars on the dealership lot is not a fixed asset, but the tow truck that they have, the tow truck that the dealership has, it that's using their normal operation is a fixed asset.
That's correct.
So it was able to understand because I was like, hold on, how do people go on and steal these cars? So I'm thinking like, okay, that the dealership losing money, but come to find out that it's not a part of their asset. That the tow truck, the tow truck
It's
that they own to come and tow cars or bring cars in, that is one of their fixed assets. So it was able to open up my mind and my eyes, like, wow, I was able
exactly
to understand that better.
wonderful. Thank you for sharing, Lakeisha, and that's a good one too. And so, to your point, let's look at Lakeisha's example, a car dealership. The car dealership sells cars, and the car dealership also has a tow truck that it owns. The cars that the dealership sells, that's inventory. It's technically an asset, but it's a short-term asset. It's not a fixed asset. A fixed asset is something that stays with the business and is used to help generate revenue for that business. Therefore, the tow truck that the business owns is a fixed asset. It's equipment, right? The cars that the dealership sells, that is inventory. The cars themselves is inventory. That's a short-term thing. Those cars don't stay on that lot for more than a year. If they do, that dealership should not be in business. Yeah, very good example.
Thank you, Professor.
Thank you. Investments are long-lived assets and are not used for investments that are long-lived assets and are not used for normal day-to-day operations are held for future resale. So in some businesses, they might have the intention of expanding in the future. So let's go back to the dealership example. The dealership has a plot of land that it parks its cars on to sell to the public. The dealership purchased a second plot of land right next door, but has not developed it, with the idea that in the future they might develop that land, or they might just sell that land. So the land next door that the dealership owns, we consider that to be an investment. It's an investment in the future of the dealership. They may either use it in the future or they might sell it in the future. So if you hold something that you have no intention on using, but you do plan on selling it later on, that is an investment. I kept this graphic in place because I thought this was interesting. Now, as you know, with any type of property, plant, or equipment, there are expenses involved. There's expenses with acquiring it, and there's expenses with maintaining it. A building, as you know. If you construct a building, there's architect fees, engineer fees. If there's insurance that is covered during the cost of construction and, of course, during operation. There's interest if you borrowed money to construct this building. There are sales taxes involved with the purchase of a building. There are repairs that you might have to make to an existing building. Reconditioning, modifying for use, permits that you need to obtain. All of these are costs associated with the acquisition of a building. Machinery and equipment. There's taxes you got to pay on purchasing machines or equipment. There's freight for shipping, installation, repairs, reconditioning, insurance, assembly, modifying, testing, and other permits. All of these things are costs associated with acquiring machinery and equipment. And of course, there's costs with acquiring land, such as the purchase price, sales tax, permits, brokerage, titles, surveying. Oh my goodness, the list goes on and on. And then, of course, if you need to make any improvements to that land, there's costs associated with that, such as trees and shrubs, fences, outdoor lighting, paved parking lots, walkways, all that good stuff. So the point of this is that there are a lot of costs associated with the acquisition of fixed assets. Now let's talk about the cost of these fixed assets. And the costs of fixed assets include the cost of operating that asset. So not only are there costs with acquisition, there's a cost with preparing the asset for use. There are other costs that are associated with fixed assets that get recorded as an expense. So for example, with my dump truck, I got my dump truck. I acquired it. Its useful life is 5 years. I use it every day for my construction business. Let's say somebody breaks into my yard. They vandalize my dump truck by spray painting it, by slashing its tires or whatever, or somebody steals it. A lot of things can happen to your assets, your car, your house, your equipment. Stuff happens, right? Life happens. It can get damaged from a fire. It can get vandalized. Somebody can steal it. There's crazy things happen in life. When those crazy things happen, we write those out as an expense on that asset. It doesn't necessarily decrease its usefulness or its useful life, but it does incur an expense. So when that happens, we expense those things out. God willing, none of that stuff will ever happen to you guys. Okay, here's an example. Kimball and Company purchased a piece of equipment for $12,000. The freight cost was $600. Again, freight is the transportation for them to receive that equipment from who they purchased it from. Then, of course, we have to install it for $1,500. And then there was an error with the installation of $500. Of course there was. But the good news is we probably got that part back, right? So how much did the equipment really cost me? So the purchase price of so I got let's see here. I've got a couple of pieces of component. The cost of the air for installing the equipment, $500, was not included in the cost of the equipment, but instead included as a recurring expense. Okay, $12,500 plus the freight, $600, plus the $1,500 for installation, minus the $500 for the expense, brings me to $13,600 for the total cost of that equipment. So of course I debit my equipment to increase my equipment line, and I decrease my cash by crediting my cash. I'm sorry, what was that?
No, I was just following you. I did that, so I was making sure that I did it right. I told you I was doing my notes.
Oh, that's right. Yep.
Yeah, okay.
Awesome. Very cool. Thank you. Okay. Now we're going to talk a little bit more about direct cost and indirect cost. Direct costs are incurred in the construction of a fixed asset, such as labor, material, depreciation. We call these direct costs. Direct costs. Like labor and raw materials. Those are direct costs. Let's look at it from an example of an auto manufacturer. An auto manufacturer uses an assembly line. And on that assembly line, we have people and we have raw materials. The people assemble the car. They're directly working with the inventory. They're directly working with that raw material. That is what we call direct labor. Then we have materials. The materials are the steel, the aluminum, and all the parts to build the car. Those are my direct materials. We include direct labor and direct materials in the construction the construction part of that car. The same example can be used in the construction of a building, which is a fixed asset. So in order to put up the building, I need to have the raw materials to build the building, and I need the people to build the building. So I have my raw materials, which is my aluminum for my walls. I got wood, I got aluminum, I got wiring, all that good stuff to put the building up, and cement. But then, of course, I have people that need to build that building. Those are that's my labor to construct the building. These two things together, we call it construction in progress. Cornelia, did you have a question?
Yes, Professor, I
Yes,
do.
please.
The first slide before the 12,000. Can you the slides? You says the 12,500, 1,500,
Yes.
please.
So you
I
just
have
need
a question about that.
I'm sorry?
Yeah, it says because this says equipment is 12,500. Where is that? Where they get that 12,500? Because if you see for purchase for equipment, it's 12,000 only.
Yeah, I see that. So that 500 what represents the let's see here.
That's why I get confused, and when I do the homework, because it's like they give me some information and they put another number, and it's like I trying to follow up in the book when I
Yeah, I see that. You know what? It looks like
read the book.
it looks like
I'm trying to follow the instructions to how to do the homework.
yeah, Cornelia, it looks like the publisher made an error here, because I'm pretty sure that this is supposed to be the original purchase price of the equipment. So this part should be 12,500 up here. It's an error that the textbook
Yeah,
made.
you're right, Professor. You're right, because I think on the home side it's supposed to be 12,500.
Yeah.
So I think in the book it might be right, because on the homework it should say 12,500. Because I remember saying this in my last assignment, last accounting class. So it should have been 12,500.
Yeah, that's an error that the textbook made.
Okay.
So it should be 12,500 for the cost of the equipment.
Okay, Professor. Okay, thank you.
Yep. Thank you for seeing that for me. I didn't notice that at first. Yeah. So 12,500 was the original purchase price of the equipment, plus freight of 600, plus 1,500 for the installation, minus 500 for the installation error. Brings us to 13,600.
Okay, thank you.
No, thank you. I appreciate you pointing that out to me.
No, because otherwise I get confused. Like
I
it's
agree.
Like,
I don't want you to get confused either.
yeah, I understand that.
Great. Thank you.
Yeah.
Lakeisha, you good? Okay. Okay. So we talked about when construction's in progress, we take direct materials, direct labor, and that comes from the raw materials and the direct labor that are being used to construct a building. That's construction in progress for a fixed asset. When the construction is complete, the costs are reclassified as we debit construction in progress and we credit the building as a fixed asset. So we credit construction in progress and we debit the building. So essentially, think of construction in progress as a contra account. You learned about that in previous chapters. Construction in progress goes up and goes down. It's like accounts payable, right? Goes up and goes down. Construction in progress, same thing. So if you look at the process, we're purchasing the direct materials, direct labor. We're putting that direct materials and direct labor into construction in progress. When the building is done, we take it out of construction in progress and we put it into our building account. Okay, let's talk about leases. Oh, leases. Oh my goodness. Just like a lease for your apartment, lease for your, a lease, as you know, is an agreement between two parties, right? The leaseor and the leasee. A lease is a contract for the use of an asset for a period of time. For example, I rent the place where I live, okay? So when I rent, I signed a lease. It's a legal contract between the landlord and me. The same thing is in business, right? We can lease buildings, we can lease property, we can lease equipment. A lease is like renting, yeah? It's the same, very similar. It's an agreement between the leaseor and the leasee. The leaseor is a person who owns the asset. So in my situation, my landlord is the leaseor, and I am the leasee. I'm the person who agreed to use the apartment, the right to use their asset, right? So that's a lease. That's the basics of a lease. Same thing can be said with a car. Some people lease their cars. It's the same thing. The leaseor is the manufacturer of the car. The leasee is you. You're the person leasing the car. Cornelia, does it make sense?
Yes, Professor, I understand.
Great. Okay. Okay, so leasing an asset has a couple of advantages, as you know. The leasee, that's the person who's renting it, right? The leasee has access to the asset without having to spend funds of obtaining financing to purchase that asset. Yeah, I mostly agree with that. There's some of it I actually don't agree with. What do I mean? Money costs money to get, okay? What does that mean? You go to a bank, you take out a loan, there's usually some things attached to getting that loan. There's an interest rate, okay? And there's usually some other fees involved. We call this the cost of capital. The cost of capital, okay? And the cost of capital is different for leasing and owning. They say, the general public says, and so does, I guess, financial experts, say that owning is less expensive than renting or than leasing. Here's why. The cost of a lease, oftentimes, they don't explicitly mention any type of interest or anything like that because they roll it in to the cost of that lease. And oftentimes, it's much higher than it would be if you had purchased it. Here's why. The leaseor, that's the person who owns the asset, they need to make repairs and maintenance to that asset. For example, I'm renting my apartment, okay?
Okay.
When something breaks, like the dishwasher or the refrigerator or the air conditioning or the heat or whatever, something breaks, it's not my problem. It's the landlord's problem, okay? So I call the landlord and say, hey, your dishwasher's broken, come and fix it, okay?
Yeah.
They need to
That's true.
pay to get it fixed. So from that perspective, it's nice to lease because you don't have to worry about those expenses. But the thing is, you know that what you pay every month for your lease, that type of stuff's included. They don't come out and say that, but you know that it is because they're not going to lose money. Come on, you already know that.
Yes. But
So,
Professor,
yes.
I think it's if you had you say how do you say the first thing? It's if it's we're in a house or a room, whatever,
Uh-huh.
we don't have something broken or something damaged from the house, you don't pay anything, right? Yes,
No,
it's the landlord who's pay that.
that's
But
right. Yeah, it's the
if you
landlord's
have your
responsibility.
if
Yep.
you have your own house, yeah. But if you have your own house, that's your responsibility
Yes.
like
If it's
like
your
a
house,
owner, right?
then that's your
It's
problem.
but
Yeah,
it's become like a big expenses, right?
that's right. That's 100% right.
And but the money you pay for the rent every month, that's a return you back. So you lose money too.
Yeah. Yep. That's right.
Yeah. So
Yep.
anyway, doesn't have benefit, advantage, and has everything good and bad, bad side, you know.
Exactly. Yep. Yeah.
Yeah.
Thank you. Thank you for sharing.
Yeah.
So yeah, there's risks involved that incur additional costs because the asset becomes obsolete and therefore its useful life can be mitigated. What does that mean? So over time, as the asset depreciates, more costs need to be going into it, and eventually the costs outweigh the benefit. And we'll talk more about that later on. So over time, fixed assets, with the exception of land, loses its ability to provide services. In other words, the building starts to deteriorate, the equipment stops working, over time. It breaks down, right? That's normal. So over time, it uses its ability to provide useful service. So the cost of fixed assets, such as the equipment, the building, should be recorded as an expense over their useful lives. Now, here's the
Okay.
interesting part. These expenses for fixed assets, we call it depreciation. The only thing that does not depreciate is the physical land itself, the dirt. The dirt underneath the building does not depreciate because we can keep using that land. I can bulldoze the building, put another one in its place. I can till the land to improve it. I can do a lot of things to the land. The land will always be there. The building will not. So, question?
No, Professor.
Okay. Okay. Let's talk about depreciation. Very, very important topic. Be very careful around depreciation. It can be very difficult to understand. So please, pay close attention to these next few slides, because depreciation is something that's going to be very important for you to understand, because it's going to help you not only for the rest of this course, but also for Accounting 202. Depreciation can be caused by physical or functional factors. Physical depreciation factors include things like wear and tear during the form of exposure to weather. In other words, if I leave my dump truck outside all the time, it's going to fade from the sun, it's going to be exposed to the elements, and eventually it will rot. Right? That's normal. The physical environments eventually break down equipment. Functional depreciation factors include things like it becomes obsolete, there's changes in customer needs, that cause the asset to no longer provide service to what it was intended. An example of this would be the iPhone 10 was replaced with the iPhone 11, then the 12, and eventually the 10 became obsolete because its functions no longer kept up with customer needs. So therefore the asset no longer provided its service. That's functional depreciation. Physical depreciation is wear and tear, right? It's just like on your car. Over time your car breaks down due to wear and tear. You need to replace your tires. You need to change your oil. You need to, keep up with the regular maintenance to prevent it from wearing out. There are two common misunderstandings that exist about depreciation. Depreciation does not measure a decline in market value over a fixed asset. Instead, depreciation is an allocation of the cost of the fixed asset to the expense over its useful life. We call this book value. What does it mean? Just think of it this way. The building, the dump truck, my example, the dump truck. I have a dump truck. I purchased the dump truck for $25,000. The IRS told me that the useful life of that dump truck is 5 years. Over that 5 years, I expect the dump truck to lose useful life. Okay, I'll put mileage on it. I'll have to keep changing the oil. I gotta get it new tires. All of these things. A lot of regular maintenance. Okay, maintenance is just expense. But the thing is, at the end of that 5 years, the value is a lot less, right? We call this depreciation. Over the use that 5 years, my dump truck will depreciate $5,000 per year in value until it reaches the end of year 5. At the end of year 5, we call it value of 0. Okay? The difference between the purchase price and the depreciation, we call that book value. Book value of an asset is less the accumulated depreciation. So purchase price minus depreciation, we call that book value. But sometimes it does not always agree with market value. Market value is something totally different. Market value is what the marketplace says it's worth. Okay? This area, there's not a lot of dump trucks in this area. Therefore, the value is higher than what the book value is. Or, in this area, there's a lot of dump trucks available for sale. Therefore, the market value is less than the book value. You see? Depreciation does not provide cash to replace fixed assets as they wear out. No kidding. You can't get refunds on things you've used. Okay. Let's talk more about how depreciation is calculated. This is very important, okay? Depreciation. Talking about how do we compute depreciation. There are 3 factors that determine the depreciation expense for a fixed asset. Number 1, how much did you purchase it for? What was the initial cost? Okay. In my example, I purchased a dump truck for $25,000. The second thing you need to know, how long is the expected useful life? According to the IRS schedule of depreciation, my dump truck is expected to last for 5 years. And the third thing you need to know is, what is the estimated residual value? Residual value is what is the expected value of that asset at the end of its useful life. We'll talk more about it. Initial cost, that's how much I purchased the dump truck for, $25,000. Plus all of the cost to obtain and get it ready for use. Now remember, the cost to obtain things include things like shipping it, installation, any type of startup maintenance, things like that. That's before you use it. What are all of the costs associated with getting it to you and getting it ready to be used? That's initial cost. The expected useful life. What is the expected amount of time we we'll be able to use it for? Usually we estimate it at the time we put it into service or at the time we start using it. So if I purchase my dump truck and I start using it that very first year, I start estimating how long it's going to be used for. Okay. Oftentimes, the IRS here in the United States, the IRS tells us the useful life of assets. We find this through the IRS depreciation schedule. Google it, it's a real thing. The IRS depreciation schedule tells me how long things will last, or how long they're expected to last. You can also get this information from industry trade associations. Like for cars, for example, you get an idea of how long a car's supposed to last by looking at the Kelley Blue Book. That's a trade industry association. This is just one example. Residual value of fixed assets is value at the end of its useful life. This is estimated at the time if the asset is expected to be put into service. Residual value is sometimes referred to as salvage value, trade-in value, scrap value. Another way to think about residual value is at the end of the 5 years, my dump truck, let's be honest, is probably not going to be worth a whole heck of a lot. I depreciated $5,000 every single year. I expect it to be worth zero at the end of that 5 years. But we know it's not really zero because the metal is still worth something. The parts are still worth something. I might be able to get $1,000 out of it. That $1,000 we call salvage value. Okay, or residual value. It's what do you think it's worth when it's by the end of its useful life? And you could get an idea by bringing what is a trade-in value. Do the same thing with a car, right? Let's say you purchase a car, you got a 6-year loan on it, you end up putting 100,000 miles on that car over the 6 years. Then you're like, okay, well, maybe it's time to get another car. So you figure out what is the trade-in value. The trade-in value is also known as residual value. It's what it's worth at the end, yeah? So we take those things into consideration for computing depreciation expense. The difference between a fixed asset's initial cost and the residual value is called the depreciable cost. This is the asset's cost that is allocated over its useful life as a depreciation expense. Again, in my example, I purchased my dump truck for $25,000. Its useful life is 5 years. I'm going to use what we call straight line depreciation and depreciate it by $5,000 per year until it reaches a value of zero. Don't worry, I'll dig a little bit deeper on that. This is the asset's cost over its useful life. If a fixed asset has no residual value, then its entire cost should be allocated to depreciation. And that's oftentimes the cost. Or that's usually the case, right? Here's another example. Let's assume that this company purchased a forklift on January 1st. The forklift cost $24,000. I expect to use that forklift for 5 years. At the end of that 5 years, I expect the residual value to be $2,000. So, how much, class, this is a good question for you, how much do I need to depreciate over the 5 years? In this example, who can tell me?
Would it be 22?
Correct. Correct, Samaya. It's $22,000. Samaya got there by taking the initial cost, subtracting the residual value, and dividing by 5. Why 5? Because of 5 years. Very good. That's 100% correct. Okay, let's look at the 3 most common methods of depreciation. One is straight line depreciation. That's the example I gave with the dump truck. I bought it for $25,000. Useful life is 5 years. I expect 0 residual value. $25,000 divided by the 5 years minus 0 is $5,000 per year. How I got there? 25,000 minus 0 divided by 5. 5,000 per year. That's straight line. Units of activity depreciation. This one's interesting. This is based off of the number of units I can produce in a given amount of time over the useful life of the asset and depreciate by that amount. So don't worry, we'll talk a little bit more about it. The third most common one is we call double declining balance depreciation. This one is commonly used in order for companies to save on their taxes. What do I mean? I got my dump truck. It's worth $25,000. I bought it for $25,000. Its useful life is 5 years. During those first 2 years, I'm going to use what's called double declining balance. So instead of declining it by 5,000, I'm going to decline it by 10,000. So 10,000 depreciate the first year, 10,000 depreciate the second year, and then I'm going to fraction off the rest of it over that 5 years. Don't worry, I'll show you an example. Companies, it's not necessary for a company to use only one method for computing it for all of their assets. What does this mean? If I have a dump truck, I also have a forklift, and I also have a building. They do not all need to use the same method. I could use straight line for the dump truck, I could use double declining for the forklift, and I could use utilities of activity for the building. So in other words, you don't need to just use one, but you need to use one per fixed asset, but you don't need to use just that same type, is what that says. So let's talk more about straight line. Provides the same amount of depreciation expense for each year over its useful life. Going back to our example, let's go to the forklift example. This is where Samaya came in with a correct response of 22,000. So Samaya, we had the original cost of 24,000 minus the residual value of 2,000. That's how Samaya came up with 22,000. 22,000, we divide that by the useful life of the forklift, which was 5 years. So for the next 5 years, each year, I will depreciate that forklift by 4,400. Does it make sense? Any questions so far? We're good? Okay.
Yeah, Professor, I have a question.
Yeah, go ahead.
Yes. When I do a homework, it's like I follow the steps, but the first time I get wrong the answer, but after check the example you post, you see you have over there. You like okay, you made you said $4,400 will be the rate for each year, right?
Correct, for 5 years.
Oh, okay. Okay, because but that's for annual depreciation or the
Yep, that's the depreciation.
declining.
Yep, that's the depreciation expense for each year.
Oh, depreciation expense. Oh, okay.
Yep.
Okay.
You good?
Yes, Professor.
Okay.
Thank you.
Yep, thank you. Okay. Good question. Okay. Now let's break it down a little bit further. How computing straight line depreciation may be simplified by converting the annual depreciation to a percentage of depreciable cost. Yeah, I guess so. Okay. The straight line depreciation percentage is determined by dividing by 100% over the number of years. This is simple. In our example of the forklift is supposed to last for 5 years. What I can do is I could take the cost minus the residual value and multiply that by 20% to get to the 4,400. How 20%? If you take 100% and divide that by 5 years, we depreciate 20% of the asset each year. So this is just basically another way of showing you how to get to that depreciation. So here we go. Depreciating that forklift. As we calculated, it's $4,400 per year for 5 years. So for the first year, using straight line depreciation, we debit depreciation expense, $4,400, and we credit accumulated depreciation, $4,400. Depreciation expense shows up on your income statement because it's an expense, right? We do that at the end of each year. This is what we call an adjusting entry. Depreciation expense, $4,400. We debit. Accumulated depreciation, we credit $4,400. Accumulated depreciation shows up on our asset. It's under the assets, okay, for fixed assets, and this basically represents a reduction of that amount for your asset, right? Accumulated depreciation accounts are called contra accounts or contra asset account. As you know, with contra accounts, it's ebb and flow, right? This is because accumulated depreciation accounts are deducted from the related fixed asset account on the balance sheet. That's why accumulated depreciation expense on the income statement, accumulated depreciation on the balance sheet, we're transferring it out, right? That's just how we reduce the value of the asset. The difference between the fixed asset account and its related accumulated depreciation is called book value. Book value of the forklift at the end of the first year would look like this. $24,000 original purchase price minus accumulated depreciation, $4,400, gives me book value, $19,600. Now you're probably wondering, well, Dr. B, what about that $2,200 of the residual value? Good question. We don't include that. The residual value does not come into play until the end of the useful life. Okay. Cornelia, did you have a question? Are you okay?
No, okay.
Okay. Okay, so that's straight line depreciation. Now let's talk about units of activity method. This one's a little bit more complicated. Units of activity method provides the same amount of depreciation expense for each unit of activity of the asset. This depends on the asset. The units of activity can be expressed in terms of hours, miles driven, or quantity produced. Units of activity method is also called units of production. It's actually more commonly called units of production. Or units of output. Units of production I like the best. That's just my personal opinion. It doesn't matter. Those terms are interchangeable, but I just personally like it. Okay, how do we compute units of activity? So first we got to figure out the depreciation per unit. How do we figure that out? We take our cost of the asset minus residual value and we divide that by the total estimated units of activity. Then the next thing we do is we take depreciation per unit and we multiply that by units of activity per period. Okay, let's go back to our example of the forklift. So the forklift, as you know, it cost $24,000. Its residual value was $2,000, giving us $22,000. Having a useful life of 10,000 operating hours. 10,000 operating hours, that's our unit of activity. I can drive that forklift for 10,000 hours before its useful life is pretty much gone, right? So, how do we figure out what is the depreciation per hour? We take our 22. I'm sorry?
We had to subtract.
I'm sorry, can you repeat that?
We had to subtract from the 24,000 minus 2,000, and then we had divide by 10,000, and then we had a 2.24 per hour.
That's correct. Yep, exactly.
Oh.
And that's how we calculate the depreciation per hour for the asset.
Yes.
That's for the forklift. So $2.20 per hour that I use that forklift during that year is how much I need to depreciate it by. So the second part is I got to figure out how long during the first year did I operate it. So
we had to multiply 2,000 2,000 hours per times 2.20 per hour.
you got it, exactly.
So then we get the answer.
Yep, 4,620. Yep. So we got the year's worth of depreciation for the forklift is 4,620. We got that by taking the depreciation per hour, $2.20, times the total hours we used it for the year, 2,100, to get 4,620. Very good.
Yeah.
Thank you.
Quick question.
Yes, please.
So the 2,100 is how many hours for only 1 year?
Correct. Yep. So Amy, the way to think about it is that not every year I'm going to drive the forklift for 2,100 hours.
Mm-hmm.
The next year I might drive it for 1,000 hours. The year after that I might drive it for 2,000 hours. You know, whatever it is.
So just the estimate of how much
It's an
you're
estimate.
driving.
Exactly. Yep.
Okay.
Yep. So we say, okay, I started driving the forklift for this many hours per day. I estimate that I'm going to drive it for this many hours for the year.
Okay.
Yep. Exactly.
Okay. Thank you.
You're welcome. Good question. Okay, and of course, as you know, at the end of each year, we need to make the journal entry, the adjusting journal entry. The journal entry for the depreciation for the forklift for that first year, we debit depreciation expense to increase our depreciation expense for the forklift for 4,620, and we credit accumulated depreciation to reduce the value of the forklift on our assets, 4,620. And we would have a similar entry at the end of each year until the value reaches zero. So here's an example of our forklift use. The first year we said we're going to use it 2,100 hours. The second year we're going to use it 1,500. The third year we're going to use it 2,600. The fourth year 1,800. And year 5, 2,000. Add all those together, we get to 10,000 total hours of useful life of the forklift. and that is units of activity. That one's, in my opinion, that one's the most difficult one to compute. Just my opinion. The third one I want to show you.
Professor, this is the one I had problems with. This
Double
Lakeisha,
decline?
I had problems. This is the one, the double declining method. And I got the straight line method, but the other two, I could not get the answer for this double declining. Because after this reason why I failed my last accounting class, I couldn't get it, but I'm so glad that you're going through and showing me each one, because we had to do one for the straight, you have a straight line method, the output, the double declining, and there's one after this one. And I kept getting it confused. I could not get the numbers right. And I was so confused. Thank you so much for taking the time out to teach me this accounting the way you do, because everyone don't get accounting, and you taught it. Everyone teaches it different. And I really appreciate the way that you teach this accounting class, because I'm able to pick it up. I was so lost in my other accounting class, and right now I just feel like, oh wow, this is so simple. This is, it's so exciting now to me. So now I'm able, because I have a better understanding of it. Thank you, Professor B.
Lakeisha, my absolute pleasure. My objective here is to make things relatable and understandable. And that's why I like to use personal examples of mine to help you all to understand it. So thank you for saying that. I appreciate that. Okay, so let's talk about double declining balance method. This is the third most popular one. Provides double declining periodic expense over the expected useful life of the asset. As I had said earlier, oftentimes businesses like to use this one because they take advantage of the tax write-offs for depreciation earlier on, which is sometimes a very useful thing to do. So there's a couple of steps that you need to go to know in order to use this particular method of depreciation. There's a couple of steps that we need to follow. The first one is first calculate straight line, okay? And what I do is I like to calculate all three methods to understand where I can best, which one is best for me, which one is best for my situation, right? So first you want to figure out what's the straight line percentage. As you know, the straight line percentage is based out of 100. So 100% divided by the number of years, the useful life, right? So if it's 5 years, we take 100% divided by 5 years to get to 20%. 20% per year. So 20% would be my step one. Step two, determine the double declining balance rate by multiplying the straight line rate. Okay, so what does this mean? I take my 20% and I multiply it by the double declining rate. Don't worry, I'll show you in the example. Step three, compute the depreciation expense by multiplying the double declining balance rate times the book value of the asset. For the first year, book value of the asset is the initial cost. Of course, because nothing was depreciated during that first year as of yet. So let's look at our forklift. There we go, forklift. Okay, initial cost, as you remember, was $24,000. The estimated residual value was $2,000. The expected useful life is 5 years. So, step one, get the straight line percentage. We said it's 20%. How we got there? We took 100% divided by 5 years, which is the useful life, to get to 20% per year. Step two, let's figure out the double declining balance rate. It's 40%. How do we get there? We took 20% multiplied by 2. You're saying, oh, Dr. B, I don't understand this part. Okay, why multiply by 2? Well, here's why we multiply by 2. Double declining.
Yes.
Double declining. 20% times 2 is double, right? So therefore, 40%. Make sense?
Yes, Professor.
Great, wonderful. Makes me so happy that you guys are getting this stuff. Very important.
That's why I can do my homework well.
Good, good. You'll get
Yeah,
there.
because
You'll get there.
I say where is I get that too, and then I say double. That's why they say double. And okay, I got it, and then I multiply like now the homework I do is the first one is 25% times 2 is 50%.
Exactly.
It's like
Exactly right. Yep.
yeah.
Very good. Thank you. Yeah, and for those and for the class, just remember, you can retake the homework as many times as you want to try to get a higher grade.
Oh, I am.
Oh, I know, and that's good. The reason why I allow that is because I want you to fully understand what it is that you're learning. And the way to do that is by practicing. And now how do you practice? Through the homework. Yeah, very good. Okay.
I've been doing they have a study guide part where I've been using that as well to kind of like help.
That does help too. You're absolutely right, Samaya. And the thing I like a lot about that is that through that study guide, they have a lot of really good examples, and that's definitely helpful as well. Okay, and then of course step 3 is calculate the depreciation expense. How do we get there? We take the initial cost and we multiply that by the double declining balance rate. 24,000 times the 40% gives us to 9,600.
Wow, Professor. I'm just saying, wow. Just how you broke that down, like one, because all of them connects to each other. So I see how
by
in
step.
order for us to get that last answer, we have to get the first two first before you even can get to that last answer. And I was trying to answer the questions like in between, but you got to start with one and work your way down. So now I see.
Right on. Exactly right. Very good. Yeah, it's important that you understand the steps, right? The steps. So that's what accounting is all about. That's why I like teaching these fundamental accounting classes, is because you're laying the foundation, okay? The better that you understand these principles, the better you can apply it to not only to Accounting 202, which will build on this course, but you get a better understanding of how businesses operate. And that's why you're taking this course. You're trying to be managers. You're trying to advance your careers. You're trying to open your own businesses, better understand your business. That's why you're here. And that's why I'm here, because I'm trying to help you all to better understand the principles of business.
Professor, you were so
Well, I need a lot of help.
I worked at a warehouse and I seen up there for the first time that it had receivables. And I was like, wow, that's in my accounting class. And I've never seen that on a warehouse before it had receivables. So now it makes me have a better understanding of what these warehouses do with the inventory that they got coming in, going out, things that are damaged and all of that stuff. So when you're not like in that business, you don't kind of think about it. But when I went out there and I said, oh, receivables, okay, so they receiving merchandise at this terminal right here. So it just gave me a better understanding of what, like you said, of understanding of how businesses conduct their business as far as in accounting.
Exactly right. Exactly right. Yep. Thank you. Okay, so looking back for the double declining balance method, how do we record it? It's the same exact process of recording your adjusting entries. We debit depreciation expense to increase depreciation expense, and we credit accumulated depreciation to reduce it. That's by 9,600, which is how we calculated the double declining balance. 9,600, we got that by taking our initial cost, multiplying it by 40%, which is our double declining balance rate. Okay, so how would that look each year, right? Because we know that 9,600 was just for that first year. Well, here's how it works. The first year, we have our cost, 24,000. We multiplied that by our double declining balance rate, 40%, to get 9,600. At the end of that first year, the forklift is now worth $14,400. How did I get that amount? I took the cost, $24,000, minus the depreciation for the year, $9,600, to get to $14,400. Now, at the beginning of next year, I would have accumulated $9,600. I got the book value at the beginning of the year, $14,400, multiply by 40% to get depreciation for that second year of $5,760. I take my $14,400 minus the $5,760 to get the $8,640. And you can see the process, right? You see all the way down until end of year 5. End of year 5, you see that I'm left with $2,000. Remember that the $2,000 is the residual value of the forklift. Does it make sense?
Yes, Professor.
Wonderful. Wonderful. Thank you. Okay, wow, that was exciting. Okay. In some cases, you'll have a partial year depreciation situation. This happens occasionally when a fixed asset may be purchased and placed in service other than the first month of an accounting period. In such cases, the depreciation is prorated based on the month of the asset it's placed in service. For example, if I purchased my forklift on March 1st, I need to still account for the depreciation from March 1st to the end of December. Okay? So that's a partial year. It's a partial year. So what I do is I do what we call prorating. I'm sure you've probably all experienced prorating in some way, shape, or form. Prorating is when I take part of the value, right? So for example, let's say you rented a new apartment and you moved in on the 15th of the month. They'll prorate that first month by the 15 days, right? For that second half of the month that you were physically living there. The same concept applies when we depreciate an asset, if we did it for part of a year. Same concept. So what you're doing is you're taking the months that were used and you're multiplying it by that depreciation rate. Or you're dividing it out to get it down to a monthly. Once you figure out what the monthly rate is, then you can multiply that by the months that you used the equipment for that year. Same concept, same concept. Assets are placed in service rather than the first day of the month. That's when this type of thing happens. So we treat it as being prorated. Okay, so for straight line, under straight line method, depreciation is prorated based on the number of months that it was in service. So if the forklift was purchased on October 1st, that means I only used it for October, November, and December, so that's 3 months. What I would do is, for that first year, I would take that annual depreciation of $4,400. I would take 3 divided by 12 and multiply that times 4,400 to get to 1,100. That will be that first year. That's my prorated amount for depreciation using the straight line. Make sense? Yeah? Okay. Okay, now let's talk about units of activity. Depreciation for units of activity rate are the following. I purchased it, instead of purchasing the forklift January 1st, I purchased it October 1, which means I used it for that 3 months. During that three months, I used it for 400 hours. Again, estimate. So we would take the rate of $2.20 per hour times the 400 to get to 880 hours for the first year of depreciation. Double declining balance, we take a very similar approach. So for double declining balance for that first year, we take that 9,600 that we would have accumulated for that first year, times 3 divided by 12 to prorate it to get to 2,400. The second year depreciation would be computed by multiplying the book value in January 1st, second year declining balance rate. October 1, 2,400, partial depreciation will be recorded. How we get there, we take 21,600 times that 40%, which is your double declining balance rate, to get you to 8,640 for that first year. This next part's not very important, so I'm trying to move through a little bit quicker. Oh, okay. Yeah. Repairs and improvements. Okay. Let's talk about repairs and improvements on the fixed assets. Sometimes, like for example, in my dump truck example, I might need to replace the engine. That is a capital expenditure. Once a fixed asset has been acquired and placed into service, costs may be incurred for ordinary maintenance and repairs. Costs that benefit only that current period, we call that revenue expenditures. Other costs may be extraordinary. Okay, an extraordinary cost is like replacing an engine. That's kind of a big deal because it can improve the asset and extend its useful life. We call that a capital expenditure. Ordinary maintenance costs and repairs are things that just take place over regular intervals. We classify those as repairs and maintenance expenses. They're not designed to improve the asset. For example, if I change the oil in the dump truck, that's just a repairs and maintenance expense. That's all it is. It's nothing more than that. Just a repairs and maintenance expense. The oil is just an expense. So here's an example. I paid $300 for a tune-up. A tune-up, they replace the spark plugs and wires and the engine, right? They tune it up. They make it run a little bit better. That's simply an expense. That's repairs and maintenance expense. You debit it to increase that expense by $300, and you credit your cash to reduce your cash by $300. For extraordinary repairs, such as replacing an engine, it's a little bit different. So let's say we overhauled the engine on the forklift. $4,500 is what it costs us to do that. The difference here is that it extends its useful life by 8 years. To represent this, we debit accumulated depreciation $4,500. That means we're reducing accumulated depreciation by $4,500 because we're adding back to its useful life. And we credit cash to reduce our cash by $4,500. We're adding back its useful life by that amount. That's the extraordinary component. Okay, asset improvements. Hydraulics for cargo, that's nice. Oh, discarding. Okay, this one's this one's kind of good to know. If a fixed asset is no longer used and has no residual value, we throw it away. We discard it, right? The discarded asset is accumulated depreciation are removed from the books. How do we remove it from the books? To recognize we're removing something from the books, we reverse the accumulated depreciation by debiting accumulated depreciation, and we credit the equipment. This represents us removing the asset from the book. We do that at the end of its useful life, and there's no residual value. So again, like my dump truck cost $25,000. I used it for the 5 years. Its residual value was 0 at the end of those 5 years. To remove it from the books, I debit accumulated depreciation and I credit equipment to remove it from the book. The reason why I remove it from the book is because at the end of the 5 years, it's not worth anything. So I can't keep depreciating something that has a value of 0. So that therefore I remove it from the book by this by making this entry. Okay. Selling has a very similar process. Natural resources, we're not going to talk about that really. Intangible assets. I'm going to mention intangible assets. The word intangible means I cannot physically touch something. I cannot physically touch a patent, copyright, trademark, or goodwill. I can't hold a copyright in my hand. I can't do that. I can't hold a trademark. The letter R with the circle on it, I can't physically touch that, right? It's not a physical asset. It's intangible. So intangible assets, we follow a very similar process for recognizing intangible assets. Intangible assets are very similar to fixed assets, but there's a couple of differences here. Determining the initial cost. How do I determine the initial cost of something like a patent? Well, there's a patent expense. When I file a patent with the patent office, I have to pay them like 30 grand. So I'll recognize that as my initial cost. Do I determine amortization, which is the amount to transfer to expenses? Amortization is a result of passage of time for decline of useful life of an intangible asset. Another time you'll see something like amortization is on a loan schedule for a house. We'll talk a little bit more about that in the near future. Patents have useful lives. So do trademarks. So does goodwill. All of these things have a useful life. Okay. A patent that's issued by the government has a useful life of 20 years, upon which I can either renew that patent or let it go. And we'll talk more about that. The initial cost of the patent include things like legal fees, and this is a debit to the asset account. Over time, it's written off through amortization over the patent's useful life. Patent amortization is normally computed by using the straight line method. In fact, most intangible assets use straight line method for amortization. Again, the word amortization, it means that we're transferring from assets to expense. We're expensing things out over time. Here's an example. I developed a patent that's worth $100,000. It doesn't expire for 14 years. So here's how it looks. Amortization expense, we debit it to increase it by 20,000. We credit patents by 20,000 to increase patents. Why 20,000? Well, we take the useful life of the patent is for 5 years. So we take the 100,000 divided by the useful life, 5 years, that's 20,000. We do that every year for the next 5 years until it reaches a value of 0. Again, it's very, very similar, very, very similar to what you're seeing through the methods of depreciation. Similar for copyrights. Copyrights can last as long as 70 years. It depends, and there's difference. The differences are in the contracts that or the agreements for these trademarks and copyrights and patents and things like that. That's what defines how long it's good for. Trademark. Some trademarks can be as long as 10 years, and they get renewed every 10 years. Trademarks are names like Coca-Cola. That's a trademark, and it has a little R at the top right corner. Anytime you see that little R, that means it's trademarked. And they follow very similar to copyright. Nobody can copy their trademark and things like that. You know, there's the whole bunch of legalities around stuff like that. I can't go using the Coca-Cola logo and expect Coca-Cola not to sue me, right? Goodwill. Goodwill is an intangible asset that is usually generated as a reputation of managerial skill. Kinda. Goodwill, the most times that you'll see goodwill on somebody's accounting or on the financial statements is that business may have acquired another business. And within that acquisition, all of the patents and trademarks and everything else gets transferred to that acquiring business through goodwill. That's the real reason why you would see goodwill on a balance sheet. At least the most common reason anyway. Okay. Financial reporting. Income statement. As you know, you would see depreciation and amortization expense. Remember, revenues and expenses show up on your income statement. Assets, liabilities, and equity show up on your balance sheet. So on your balance sheet, of course, you'll see long-term fixed assets. You'll see other assets, intangible assets, so forth and so on. Of course, it's all going to be on your balance sheet. Okay, ratios. I know you guys love ratios. Fixed asset turnover ratio. This measures this number of sales dollars earned per dollar of fixed assets. To calculate that, we take our total sales for the year, divided by our average book value of fixed assets. As you know, book value is the initial cost of the asset minus the depreciation, right? That gives you your book value. The higher the ratio, the more efficient a company is. Okay, that's the end of the chapter. Yay! Oh my goodness, that was so long. That was incredibly long. Okay, that was chapter 9. I'm going to quickly stop the recording, and then we'll jump into chapter 10. I know that some of you probably have class coming up at 1 or after 12:50. So, if that's the case, no problem. Don't worry. It'll be recorded. You always go back and watch. For those of you who don't, and if you want to stick around, you're more than welcome. If not, I totally understand, and my feelings won't be hurt. And as always, if you have questions, please feel free to email me, contact me any way that you can. I'm gonna stop the recording, and then we'll start chapter 10.